Credit cards are everywhere. But what if I told you that some of the things you've been told about them are completely wrong? Maybe you've heard that carrying a balance improves your score, or that checking your credit hurts it. Well, let's bust some myths today. Myth number 1. Carrying a balance helps your credit score. A lot of people think they need to keep a balance on their credit card to build their credit score. But here's the truth. That's completely false. Your credit score is based on how responsibly you use your credit. Carrying a balance doesn't help. It only makes you pay more in interest. Let's say you charge $500 on your credit card. If you only pay the minimum, you could end up paying hundreds of extra dollars in interest over time. What actually helps your credit score? Paying your balance in full every month and keeping your credit utilization low, ideally under 30% of your limit. Myth number 2. Checking your credit score lowers it. This is one of the biggest misconceptions out there. People avoid checking their credit because they think it will hurt their score. But that's not true. There are 2 types of credit checks. Soft inquiries. These happen when you check your own credit, and guess what? They don't affect your score at all. Hard inquiries. These happen when a lender checks your credit for a loan or a new credit card. These can cause a small dip in your score. So checking your own score is actually a good habit. It helps you stay on top of your credit health. Myth number 3. Closing old credit cards improves your score. Thinking of closing that old credit card you never use? Wait, it might actually hurt your score instead of helping it. Why? Because closing a credit card can lower your total available credit. This increases your credit utilization ratio, which can hurt your score. Shorten your credit history. The longer your credit history, the better your score. Unless the card has a high annual fee, it's often better to keep it open and use it occasionally for small purchases. Myth number 4. Your income affects your credit score. Many people assume that the more money you make, the higher your credit score. But guess what? Your income is not part of your credit score. Your credit score is actually based on 5 key factors: payment history, credit utilization, length of credit history, credit mix, new credit inquiries. Even if you make a 6-figure salary, missing payments or maxing out your credit cards can still tank your score. So, how can you really improve your credit score? Here are 4 simple steps. Pay on time. Your payment history is the biggest factor in your score. Keep your credit utilization low. Aim to use less than 30% of your available credit. Don't apply for too many new credit cards at once. Too many hard inquiries can lower your score. Check your credit report regularly. Mistakes happen and you can dispute errors. Credit cards can be powerful tools if you use them wisely. Now that you know the truth behind these common myths, you're one step closer to better credit and financial success. If this video helped you, hit that like button and share it with a friend who needs to hear this. And as always, stay smart with your money.